Hello everyone, welcome and thanks for watching the market report. This is Marcel Pechman, analyst and writer at Cointelegraph. On today's The Market Report, we'll be discussing whether Bitcoin's 28,000 support has a chance and why the US Federal Reserve decision on interest rates should be initially negative for crypto. Lastly, we'll analyze the First Republic Bank failure and its subsequent acquisition by JPMorgan. Don't miss it, and make sure to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. We will start by covering an article written by our very own Marcel Pechman. Will 28K Bitcoin price hold? Two indicators remain solid despite the 5% pullback. Bitcoin margin markets and futures long to short indicator show professional traders are unwilling to bet on the Bitcoin's price drop. Bitcoin saw considerable volatility between April 25 and May 1st, ranging between 27.2 thousand and 30K. From a trading perspective, that 10.5 move sounds alarming, resulting in 340 million in leveraged Bitcoin futures contracts liquidations. Okay, so what are those liquidations and how relevant $340 million is? For those unfamiliar with future contracts, one can basically deposit $1,000 and trade 10 times that number. So buy or sell Bitcoin futures worth $10,000. If the asset prices increases by 3%, the buyer gets 30% returns. The problem is the exact same happens on the downside. So a 3% price decline equals you lose 30% of your deposit. If the price decline is 9%, you are wiped out. You are liquidated of your entire $1,000 deposit. Futures markets are extremely important, not only for cryptos, but for every tradable asset, including stocks, gold, oil, and foreign currencies. Besides degen gambling, it allows producers and consumers to hedge their exposure. For instance, an airline company could buy the futures contracts equivalent of the kerosene, the gasoline and oil price needed for the next 6 months. So the price oscillations in that period would not be relevant for the company. That's called hedge position. However, a 340 million liquidation for Bitcoin shows some market flaws, as there's no liquidity to sell $100 million at market if leverage buyers suddenly face a price crash. For instance, if there's a lot of leverage buyers and the Bitcoin price crashes 10%, then there will be a lot of leverage stops, meaning the exchange will have to sell those contracts to end the risk. So the liquidation engine is forced to push down the price, whether it's 10%, 20%, it doesn't matter, until the order is completed. That's what's called liquidation. Now, let's analyze margin and futures markets to understand whether whales and market makers flipped bearish as Bitcoin approaches 28,000. We'll start by analyzing the margin markets. OKX provides a margin lending indicator based on the stablecoin over Bitcoin ratio. Traders can increase their exposure by borrowing stablecoins to buy Bitcoin. On the other hand, Bitcoin borrowers can only bet on the price decline of the cryptocurrency. So basically, the higher the chart, the more bullish traders are because they are borrowing stablecoins, so they use that amount to buy Bitcoin. On the other hand, if the indicator goes down at OKX, it means that more Bitcoin is being borrowed, so it's used to bet on the price decline. The chart shows that OKX margin lending ratio increased between April 17 and April 30. That's somewhat concerning, as it shows that leverage has been used to support the price gains. So margin markets borrowing stablecoins to buy Bitcoin was used to prop the price up to $30,000. Moreover, the 43% ratio favoring Bitcoin longs on April 27 was the highest level in 40 days, indicating overexcitement as Bitcoin flirted with $30,000, which adjusted down to 32% after the latest correction down to $28,000. So we're not more in the overexcitement period, but we flashed overexcitement on April 27 as we tested the $30,000 resistance. Okay, so the important message here is buyers used leverage to prop Bitcoin's price to 30K. That alone explains why the correction down to $28,000 was so brutal. Now let's move to Bitcoin futures markets to double check whether the leverage was also used on that market. The long to short metric gathers data from exchange clients' position on the spot, perpetual, and quarterly futures contracts, thus offering better information on how pro traders are positioned. So there we have the OKX top traders long to short ratio, which increased from April 27 to May 1st. Also the Binance top trader long to short ratio, which also increased starting from April 27 up to April 30. So yes, additional leverage was used on futures contracts as well at OKX and Binance. On the bright side, even though Bitcoin failed to break $30,000, professional traders have increased their leverage long positions using futures, according to the long and short indicator. Therefore, the 5% price decline from a high of 30K on April 30, the bears using futures contracts were not confident enough to add leverage shorts at bets on the price decline. Simply put, even if Bitcoin retests 28,000, bulls should not yet throw in the towel, as both margin and futures markets indicators remain healthy. So I'm not saying that a dip to $27,000 or $26,000 can't happen. Data is merely saying sellers had no courage to bet on the price decline using markets, margin, and futures instruments. Just to highlight, that's my own opinion and does not constitute investment advice nor reflect Cointelegraph's official view. Now, on to the next topic, covered by Prashant. There's the First Republic Bank failure over the weekend. JPMorgan to acquire troubled First Republic Bank. Banking giant JPMorgan will take over the assets of the troubled First Republic Bank after its seizure by the California Department of Financial Protection and Innovation. FRP was closed on May 1st and entered into an agreement with the Federal Deposit Insurance Corporation, FDIC, as the receiver. The FDIC then entered into a purchase and assumption agreement with JPMorgan to protect investors. JPMorgan will assume all assets of the First Republic Bank, including uninsured deposits. FRB currently has $230 billion in assets. Okay, so we've got 2 of the top 20 US banks failing within a couple of months. It's becoming increasingly hard to justify that mismanagement was the root cause for the bankruptcies, or that a specific sector or region was to blame. Is this a bailout? Yes, because the FDIC is getting emergency funding from the US Treasury to cover the losses. In First Republic Bank's case, it is estimated at an initial $13 billion hole, although JPMorgan will have a couple of years of loss share agreement with the FDIC. Basically, any profit goes to the bank, which is estimated at $8 billion. And eventual losses, surprise negative outcomes, will be shared with the FDIC, which in turn will handle it to the US Treasury using the emergency bank program. So yes, it is a bailout. Why did Bitcoin price go down after the event? Well, it could be 2 things. A, the news was already priced in. Bitcoin gained 7% between April 25 and April 29, while the FRB stock price plunged 80% from $16 to $3 a share. B. Investors may have interpreted the move as a strong signal from the government, meaning they won't let any of the bank fail without a bailout. That's very different from 2008, when the Lehman Brothers failed. Make no mistake, yes, the US Treasury has unlimited funding. They can print all they need or take out bad debts from banks and replace those with cash or US Treasuries. However, in the mid to long term, this creates additional need for funding for the US government. The US dollar already weakened against other major currencies and will continue to devalue if the banking crisis makes other victims. Ultimately, no depositor is harmed, but the value of those dollars in the bank are worth less every month. That's called debasement, which is the ultimate tax, and no one can escape, unless you opt for hard and scarce assets. That's why Bitcoin will be benefited, maybe not in the short term, but certainly in the span of 1 to 3 years. For our last topic of today's show, I'd like to introduce you guys to the VIX indicator, which is the volatility indicator of the S&P 500 index. So volatility means surprise price moves. It doesn't matter if up or down, but if the traders are pricing in higher risks of strong price moves, the VIX indicator goes up. On the other hand, if people are expecting price stability, means it's going up 1% every day for the past 2 weeks, or there hasn't been a crash of 4% or a price hike of 4% in over a month. So everyone expecting the prices to go up 1 or 2% or go down 1 or 2%, but vary without strong oscillations, then the VIX indicator goes down. So it's a volatility indicator based on what players are expecting using options derivatives contracts. So a high VIX means the market is expecting a strong price oscillations, or at least it happened in the short history time. If the price has been kind of stable over the past weeks, the VIX indicator goes down. So there we have the VIX indicator for the S&P 500. You can see that it's currently sitting at 18.5, but it recently touched 16% on April 28. That was the lowest level in 18 months. So since November 2021, we hadn't seen any volatility this low. That doesn't mean that the market is expecting the prices to stay put. It just reflects how the prices have been moving over the past weeks. So no one is expecting huge price oscillations right now. But if you go back to November 2021, that was a couple of months before the S&P peaked at its all-time high. Let's cross-reference with the S&P indicator. So November 3rd, we got the 15 indicator for the VIX, the lowest in a long time. S&P price was 4.7 thousand. A month later, it touched 4.8 thousand, which was the all-time high, and since then started to decline pretty fast down to $3.7 thousand. So what I'm saying is that VIX indicator being low is commonly interpreted as markets being very calm or not expecting strong price move, but that's just the opposite, because it reflects what traders have experienced over the past month. So we could see a really fast change on the VIX, meaning the market can go up by 20% or down by 20% within a month, because the VIX is currently low. And why does surprise moves tend to happen when the VIX indicator is low? Well, because when the volatility indicator is low, means that you can buy or sell options at a low cost. So people tend to use excess leverage during those periods. So if the market crashes 5%, or goes up 5%, there's a lot of liquidations on futures and options markets, and that tends to escalate the move, whether up or down, creating additional volatility. Well, that's it for today. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving possible alerts for months. There's a 20% discount in the video's description. See you!